direct to consumer is the key now, I think, for investors in terms of where their focus is. What did you hear on the call that was incrementally more information that we've gotten previously that sort of helps to clarify your view of the opportunity and the cost?
Yeah, so I think cost actually is the key component. We walked out of that call with a much better handle on what earnings look like, not just for the next couple years, but we actually published numbers today out to 2025, which is really the timeline you need to think about for these investments Disney is making. They talked about the foregone licensing revenue they'll have at the studio. They talked about some of the technology and engineering costs, some of the startup costs. I think investors are more and more getting their hands around exactly what this looks like from a financial standpoint. And to me, that's the last catalyst, kind of getting that uncertainty out of the way for the stock to break out later this year.
You're clearly then making assumptions in terms of how many subscribers they're going to have, aren't you?
I am.
And what kind of ramp are you giving them in terms of the growth of that base?
Yeah, certainly. So I think they'll be exiting 2020 with around 50 million total subscribers between Hulu and Disney Plus. That puts them, certainly in the top tier of major streaming global platforms.
Where's Hulu right now?
Hulu's at 25 right now, so that is
an incremental
big chunk of that.
23 million subs or something like that.
Yeah, Hulu will add a few between now and then the rest will come from Disney Plus. But I think a $15 to $20 million sub number for Disney Plus is where they can get to in a couple years' time. And if I'm right on that, then this is the stock to own in the S&P.
Laura, how should we think about the risks associated with Bob Iger saying that direct-to-consumer is the #1 priority, and the foregone revenues from licensing from the likes of Netflix? I think 150 million was a figure that Disney put on it last night. What if they don't execute? How long do they have?
Well, let's do some math real quick. So 150 million is the money they're going to lose from Netflix licensing this year, mostly in the second half. Then he said he spent 100 million in the quarter just ended. He's spending 200 million this quarter. Let's assume 300 million next quarter and 300 million the quarter after that, which means round numbers, you have $1 billion tax. Let's call it a DTC tax or OTT tax. And they have about 1 billion for shares. So you're getting about somewhere between 50 and 60 cents downdraft per share this year at a 20 times PE multiple. So there's something like 15 or 20% downside to the shares, assuming this tax continues as they roll out. That excludes any marketing expenses assigned with launching the channel, which this is a marketing juggernaut. So you should expect to see good marketing expenditures around the launch. So I think that's the issue with Disney is when they do their Analyst Day in April. We think they're going to put a fine point on something like between $800 and $1 billion of spending for the next 2 or 3 years on going DTC, which may pay off in the long term because that's his job. But for shareholders, we think there are better places to put your money in the next 12 months.
Laura, what is the key to me here, and I wonder want your opinion, obviously, is Iger believes the long-term growth of the company will be stronger than it would have been without these investments. But will it ever be what we've seen in the old universe? It's going away. That we know that ecosystem is breaking apart. So there's no old world continuing. But is the new world going to be as profitable as the old one?
Well, importantly, one of the things they said was that both Viacom and Disney said that the linear TV ecosystem deterioration moderated to down 1%, used to be going down 3%, so that's interesting. And then they also said that scatter pricing in the advertising market is up 40% over May rates. So right now it feels like the linear TV ecosystem is doing much better than expectations.
Steven, I get that Disney is putting a lot of money towards this over the next couple of years, but they're going to be a direct competitor to Netflix and probably one of the most formidable competitors to Netflix. Does that in of itself warrant a greater valuation?
I think it does. I think it does for 2 reasons. Number one, there's a defensive element to this, which is that Disney could probably manufacture higher earnings in the short term by selling its content to Netflix, but they're essentially, helping undo some of their own market position. And then the offensive element is the global addressable market, and I think that's the key in direct-to-consumer. This isn't just taking a linear channel and making it available on your smartphone. This is taking content that's already global in nature, taking a relatively fixed global content cost and amortizing that on a global basis. I mean, I think Disney could be at, half the size of Netflix subs in 5 years, and people think Netflix could be at 250 million or 300 million subs. Even Disney at 75 to 100 million subs subs is a much more profitable business than what they currently get today by just doing business with those other global streaming providers.
Laura, let's talk Snap. It's up 28% so far this morning, but still just at the levels where it was the beginning of September. They're talking a lot about Android and getting ready to launch that, but I feel like before the IPO, they were downplaying Android, saying that they were focused on premium users and Android didn't matter so much. Has the story really changed that much, or are they grasping here?
Well, I think it's interesting that we don't hear Google whining about Android. Remember, Snap is a 100% mobile company. And Apple only has 15% of the mobile market. So the fact that they're not succeeding on the 85% penetrated mobile platform, I think is troubling. Their costs are down 50%, which is great for this year, but I don't know what you do for an Encore next year. And they're stable. Everybody's clapping. We have a sell. We're one of those sells on Snap, so we're wrong today. But everybody's clapping because their users were stable at 186 million. But let's recall that Instagram, owned by Facebook, copied everything Snap did and now has 500 million users, just copying Snap. So, clapping for Snap's 186 million stable users, I think is, praise too high. That's my view.
Laura, I want to get your thoughts on the video game stocks. They are leading the S&P lower today. Take-Two, Activision, Blizzard, and of course EA. Your thoughts?
Shocking that they released. We had a game on the schedule for a year, premium game, and they released it for free, encountering Fortnite. So after telling us for a year that Fortnite didn't matter and wasn't affecting them, suddenly they've launched a Battle Royale free game instead of a premium game, which it is taking a big tax on, their earnings. I think people are really disappointed by that. And then also Battlefield 5, yet another failure in the shooter mode from EA. So they're taking numbers lower. I think they've taken numbers lower 3 times in the last 2 quarters. So that all is bad for outlook, and these are expensive stocks. So while they own their IP, so that's okay in the end, they have a real content problem at EA today.
And you have been busy, Laura, I would think.
I have. I'm on the wrong side of a lot of trades today. Today's a bad day in my world.